Okay, I think we'll get started. Welcome everybody. This is, I believe, the first of the new initiatives by the LIWMPC to run introductory sessions on various actuarial concepts. Despite the title, this is nobody should feel like they're a dummy on this. There's no prior knowledge expected. Nobody's going to judge you for questions if you think questions are too basic. The point of this session is really for everybody learning and for everybody to get some insights from our speakers today. So with that, I'm just going to introduce our three speakers. Starting off, we've got Tyson, who's going to speak about policy liabilities. Tyson's a recently qualified fellow and a senior consultant at EY's Actuarial Services. He works primarily in life insurance and has experience with valuation, pricing and capital management. He's going to cover policy liabilities, so particularly he's going to give a high-level overview of policy liabilities for Australian risk business and how they're calculated. He'll focus in particular also on assumptions of future experience change and how that flows through our policy liabilities. Next we're going to have Kuan Yi Tan, who's capital reporting actuary at TAL. She's going to talk about capital calculations and the logic framework, particularly giving an overview of how it works, what the particular risk charges are, and the various components to be aware of. Kuan Yi's, as I say, working at TAL. She delivers regular capital reporting and insights into the business on matters relating to capital. She's a qualified actuary with over 5 years' experience in the insurance industry, in corporate and consulting environments. She's worked with companies in Australia and in Southeast Asia. And finally, Kirsten is going to talk about value, which is, again, an increasingly important area for actuaries to be focused on. Kirsten is a recently qualified fellow also. She's specialised in life insurance and is also interested in wider fields. Her current role at TAL is focused on the production and communication of regular financial reporting, including calculation of policy liabilities, analysis of profit, capital calculations and economic value. Kirsten's particular focus today will be on value and I guess who cares about value, who it's important to, and various ways of understanding the value of life insurance business. So with that, I will hand you over to Tyson to start us off with discussion on policy liabilities.
Okay, so thank you for that introduction, Noel. As Noel said, it's back to basics today. So thank you everyone for coming. I'll be kicking things off with a discussion about policy liabilities, and I'll be focusing on Australian individual risk products. So we're talking death, YRT products, disability, things like that. Policy liabilities are a good place to start because they really are the crux of financial reporting. If you don't get your policy liabilities right, it's really difficult to get your capital position right and your value right. So let's start with what are policy liabilities. So a liability in general is an obligation to pay something. It is an expected outflow that will sit on the company balance sheet. In life insurance, we exchange premiums for the obligation to pay something. So it will be paid claims that are covered under the relevant terms and conditions of the product. So policy liabilities are required to sit on the balance sheet so that company accounts represent the true and fair value of future obligations to policyholders. Now Australia is a fairly highly regulated country where the financial system is highly regulated, and that's for protection of policyholder interests. It's no exception in the insurance industry with policy liabilities, and a lot of what I'm going to describe today is how to apply the various principles of the relevant standards. And in this case, the key standards here are APRA's Prudential Standard LPS 340 and the Australian Accounting Standards Board, or AASB 1038. So let's kick things off with how to calculate policy liabilities. So the most common method for these types of products is a projection method. And as the name suggests, it's a projection of future cash flows discounted back to time zero. their standard suggests that there are alternative methods that can be used so long as the principles of the standard have been met. So the next most common method is the accumulation method, and that's commonly used for group risk business, which typically has a shorter time period and less detailed policy projections. So projections will usually be done on an individual policy basis, so that can be a bit more difficult for group business. Now let's have a look at the components of policy liabilities. So there's two main parts. The first component is the BEL, or the best estimate liability. And this is basically the present value of the estimated future cash flows, estimated using best estimate assumptions and using a risk-free discount rate. Now, I highlighted best estimate assumptions there because that's quite important. It means that it's equally likely to be more or less than that amount, and any allowance for additional risk comes through in capital, and that's what Kwon Yi is going to talk about. The second component is an allowance for future profit. So that sits within the policy liability to ensure that profit is released over the life of the policy rather than at inception. So if we've got profit within the liability, we need some standardised way to release that profit. So that brings us on to profit recognition. So in life insurance, we will receive some premiums, we'll pay some commission to advisors, we'll pay some expenses, and we may or may not end up paying a claim. As a result, profit is really only known after each policy has run off. So as an example, you might have one policy that pays premiums for 3 or 4 years, we pay some expenses, and then it claims. On that particular policy, there's going to be a big loss. But to offset that, there's going to be lots of policies that pay premium and don't end up claiming. So I guess the aim is over a portfolio of products to have a profitable business. So now, as I said earlier, we need a standardised way of recognising that profit over time, and that's exactly what MOS aims to do. So MOS is the financial reporting methodology used for life insurance contracts in Australia. It stands for Margin on Services. As the name suggests, MOS ensures that the planned profits are earned in line with the service provided to policyholders. I'm not going to go into too much detail on the service here because it can get quite technical, but for today's sake, let's assume that the service is the expected claims that will be paid to policyholders, as really that's why you take out insurance. So in the event that you may need to claim, you can. And so MOS ensures that there is zero profit at inception, followed by a smooth emergence of profit. So we're now just going to spend a little bit of time looking at the example down the bottom there, which compares the nominal cash flows with a planned profit under what would be a MOS scenario. So you'll notice that the nominal cash flow has a large negative at the beginning of the policy, which would represent the acquisition costs associated with acquiring the business. So things like commission to advisors. Contrast this with the planned profit, where you see a smooth runoff of profit over the life of the policy. So the way that this is achieved under MOS is that a negative liability is set up to offset that initial acquisition expense. And that negative liability is called the DAC, or Deferred Acquisition Costs. And the principle is that on an ongoing basis, the profit that the business is going to make will pay down that acquisition cost, which is effectively being deferred. So that has important capital implications that Kwon Yi is going to talk about. The other thing that's worth noting is that there's some management signals that you see in the contrasting shapes of the profit. Obviously, if you're a company that's writing a lot of new business, the nominal cash flow there will be quite volatile compared to the planned profit. Now, here is an example of policy liabilities at inception. It's quite a detailed slide, but we're just going to focus on a few key things. I'm going to see if this pointer works. It does, brilliant. So first of all, we're going to look at the BEL. The BEL, as I mentioned, is the best estimate liability, and it's the present value of your future cash flows. So that's these. A couple of things to point out. First of all, this is a liability side, so that's why the premiums are negative. Second thing to point out is that the BEL is negative. So this means that the future expected premium will offset the expected claims, expenses and other costs, or that we expect to make profits from selling this product. So if we're expecting to make profits, we need to set up the other part of the liability, present value of future profit. So under MOS, by construction, the liability at inception has to equal 0. So then the present value of profit margins is just equal to the negative of the BEL. The next step is to work out the profit margin, and that's quite simply the present value of profit divided by the present value of the profit carrier, which we talked about earlier, which in this case is claims. That gives us our 23%. And the last step there is to work out what our profit stream is going to be, which is this line down here. And that is simply the profit margin multiplied by the claims cash flow in each year. So it's quite simple setting up a policy liability at inception. But what happens when things change? What happens when our expectations of future experience change? And what happens when economic assumptions change? We all know economic assumptions can be volatile. So this is a typical assumptions cycle. Now this is something that's different in every company, but typically companies will look at experience on an annual basis and compare this to their prior assumptions. A few of the key things that differentiate how companies look at this is whether they use industry data, how many years of historical data, and things like what the emphasis is on historical data versus future expectations. Nevertheless, assumptions are reviewed and they're updated if necessary. And any updated assumptions need to flow through into the policy liability, which is what I'll discuss in the next few slides. So the last section to close out the loop is the analysis of profit, which we won't focus on today, but it's another useful tool to analyse how your experience is going. So there's two main types of assumption changes that we can have. The first is an economic assumption change, and that's things like discount rates and inflation. And changes to economic assumptions directly impact the value of policy liabilities, and as a result, they'll flow through to the P&L, the profit and loss statement. For some products, like annuities, this is usually offset by movements in asset values. And this is where asset liability matching becomes important. If you have a liability of 100, say, and a discount rate of 5%, and discount rates drop to 2.5%, then you're discounting those cash flows at a lower rate, and the liability is going to be higher. So what companies will try and do is match their assets and liabilities, so that any change in the value of the liability can be offset by a change in the value of the asset. Now, for life risk products, as we've talked about, there might be a DAC or a negative liability. It gets a little bit more tricky in this case, and often the movement goes straight through to P&L. So non-economic assumption changes, or other assumptions, are things like claims and expenses, and usually changes in these assumptions don't impact the value of policy liability. There is a catch to this, which is when products become loss-making, which under APRA's regulatory standards needs to be capitalised immediately. So if you change your non-economic assumptions, any change in the BEL is absorbed by a change in the present value of profit margins. I've got a couple of slides after this which provide some examples on this. But if you change the present value of profit margins, it's going to impact the future profit stream. So effectively what that does is it smooths out the change in assumption into future profit rather than current profit. And the last point there is that if the present value of profit margin is reduced to 0 and enters loss recognition, it needs to be capitalised. And effectively what this means is that if you're expecting to make losses on the product, it's no longer profitable, it needs to be capitalised immediately. So I'm now just going to show two examples of exactly what happens when we change our assumptions. So in this example, it's a fairly vanilla change. It's a non-economic assumption change, and in this case, we have already updated our discount rates. So we're strengthening assumptions. So we've gone through our assumption cycle and our claims experience has been worse than expected, and we need to update that assumption. So say we bump up our claims assumption by 10%. That's interesting. What's going to happen there is we're expecting more claims to come through, and the claims cost therefore will increase, and our best estimate liability is going to increase. So if you think about it intuitively, we're expecting more claims, we should be expecting less profit, unless we adjust our premiums. But in this instance, we're just considering an isolated change in claims. So in order for the policy liability to remain unchanged, what needs to happen is the present value of profit margins basically needs to increase from here to here, or it needs to reduce to offset that increase in BEL. Now it gets a bit more complicated. And admittedly, this is a fairly extreme example, but moving in and out of loss recognition isn't something that's uncommon in the industry at the moment. So in this case, we've reviewed our assumptions, and rather than just bumping up claims, we need to change claims, expenses, everything. We were way off. So our BEL in this case increases by more than the value of our old present value profit margins, and in effect, the policy becomes loss-making. So what needs to happen is the present value profit margins will reduce to zero, and any further losses will need to be capitalised. So the loss recognition amount will equal the new BEL minus the old policy liability, and the new policy liability will be set equal to the new BEL. So by construction, when we work out our profit for the year, and it includes that change in liability, the liability is going to increase quite a lot, and effectively that amount of loss recognition will be capitalised. So we've talked about how to set up a policy liability at inception and how to change it when our assumptions change and discount rates change. But there's a lot of other complications that weren't considered in this fairly simple example. For instance, this focused on individual risk business. Other products can have very different treatment, and I guess the examples are investment business like unit-linked and term certain annuities. They can be simple, they can be quite difficult. Traditional business like participating and non-participating business, that's always everyone's favourite, is an entirely different beast altogether. And group risk business I touched on earlier, becoming more important. It's usually done using an accumulation method. The next point there is that the calculation is quite easy compared to checking the results. Depending on the processes of the company, it can be as easy as clicking a few buttons and then out pops your liability. But what can be difficult is checking that it's actually right, looking at movements and things like that. And I guess another point that I raised was that a lot of what I've mentioned today is how to apply the various principles of the regulatory standards. Well, there's a new one coming out soon, and it's going to change how we need to do things. So there's a new international accounting standard that's still on track to be released next year, and it will change a number of things and how we need to calculate our liabilities. So that's all for policy liabilities. I'm now going to hand over to Kwon Yi to talk about capital.
Thank you, Tyson. Can you guys hear me all right? Okay. So Tyson has talked about policy liabilities, and everything in policy liabilities is based on the best estimate assumptions. So best estimate assumptions, what does it mean? It means we have a 50-50 chance of meeting obligation to policyholder. So think about it, if you're a policyholder who bought a policy from insurance company, and we tell you that we have a 50-50 chance of meeting that obligation to you, you probably won't be very happy. And if you're a regulator like APRA, you won't be very happy too. So that's where capital comes in, and that's where we allow for buffer on top of policy liabilities. I'm just going to take a step back and read out something from our Prudential standards. What is capital under LEGIC, Life and General Insurance Capital Standards? It's probably the only time I'm going to read out a whole paragraph from the slide, so just bear with me. Okay, sorry, I'm a bit short, so I'm just going to... The prescribed capital amount of a fund determined under the standard method is intended to be sufficient such that if a fund was to start the year with a capital base equal to the prescribed capital amount and losses occurred at the 99.5% confidence level, then the assets remaining would be at least sufficient to provide for the adjusted policy liabilities and other liabilities of the fund at the end of the year. So there's a few things that I mentioned. Prescribed capital amount, capital base, 99.5% confidence level, adjusted policy liabilities. I'll come back to these few terms in the next few slides, but just bear them in mind. The prescribed capital amount is basically the capital that we need to hold, and it's the summary of a few components. In the summary of insurance risk charge, asset concentration risk charge, operational risk charge, aggregation benefit, and combined stress scenario adjustment. Some of you who work in this field might know these terms at the back of your head, but some of the terms might not seem intuitively clear to you. I'll go into further detail in the next few slides. So in calculating all these different charges, what we are actually doing is to allow for buffer on top of the best estimate assumptions. So these margins, some of them are set by APRA. So for example, asset risk margins and operational risk margins used in calculating asset risk charge and operational risk charge. Those are set by APRA. But appointed actuaries would actually set most of the margins for insurance risk. Before we go into the detail of how we calculate each of those components, I just wanted to take a step back and think about why do we report and why do we calculate capital in the first place. If you think about capital, it's a lot like managing your own budget, really. In managing your personal budget, you want to spend less than you earn, so you don't want to rack up crazy credit card debts. You want to meet saving targets, so you want to save X% of your pay every month, for example. And you want to anticipate for things in future. So for example, buying a property in Sydney, which costs a lot of money right now. So think about that in terms of capital management. You want to meet regulatory requirements, which is what the paragraph I just read out, what APRA wants us to hold. You have strategic KPI that you have to meet. So for example, some companies have capital efficiency indicators, such as return on capital. You have to meet those requirements. And more importantly, you have to make sure that you have enough money to fund any planned business growth that your company might have. So in essence, capital is all about determining how much we have, how much we can spend, and are we going to run out of money. So that's what capital is. What I'm going to do now is to try to tie capital into the rest of the items in your balance sheet and see how it all links together. I'm just going to try this out. Okay. So let's start with assets. So assets, something that all of you will be familiar with. So on the balance sheet, on the asset side, you will have X amount of cash, equities, bonds, receivables, so different types of assets. And on the liability side, you have your policy liabilities, which is what Tyson talked about earlier. And then if you've got other liabilities. You take your assets and take away your liabilities, you get your net assets. But the key point to note is that not all of your net assets can be used as your capital base. So just bringing back to that paragraph which I talked about in the first slide, we have to make sure that our capital base is enough to fund adjusted policy liabilities. So in the standards, what we need to do is to make some regulatory adjustments so that we get a number for capital base. So what are the regulatory adjustments we need to do? The first one, which is probably the most significant one for a lot of companies, is the liability adjustment. So just bringing back again to that first slide, we have to hold enough capital in the capital base to support adjusted policy liabilities. Adjusted policy liabilities is not just net policy liabilities. So for example, if you have debt, like what Tyson mentioned earlier, so that has to be removed from your net policy liability. Oops. And a few other things as well. If you've got deferred tax assets, which are more than your deferred tax liabilities, that's another regulatory adjustment you need to make. And you've got any intangibles, such as goodwill, that has to be deducted from your net assets as well. And there's a few other things which are listed out in the capital standards, but I'm not going to go into more detail here. The most important thing to note is just that we have to make certain adjustments to your net assets to arrive at your capital base. Now, this capital base will be used to support all the capital demands that your company has. So the main capital demand would be the PCA, which is made up of the different risk charges which I mentioned earlier. Your insurance risk charge, your asset risk charge, aggregation benefit, operational risk charge, etc. But it is not just sufficient to hold that. Most companies also hold target capital. So this is essentially a buffer that you hold on top of your PCA so that you have a very small likelihood of breaching the PCA. Think about it in this way. If let's say you only hold PCA and you write one more policy, that means that you're in technical breach of what the regulator, who is APRA, wants you to hold. So this is why companies typically hold a certain amount of buffer on top of that. The calculation of target capital is quite a complex thing, which I'm not going to go into at this point. But I just want to draw out the point that we have to hold something above PCA. Anything above that is your available assets, which you can play around with. I'm now going to go into detail of how we calculate each of the different risk charges, which I mentioned on the earlier slide. So the first one is insurance risk charge. To calculate insurance risk charge, what we do is that we apply the various stresses on adjusted policy liabilities. Now I mentioned that I'll talk more about this in the next few slides, and here we are. What is adjusted policy liabilities? Adjusted policy liabilities is not just your net policy liabilities. So for example, like I mentioned, if you have debt, that's not included under adjusted policy liabilities. Under the regulations, adjusted policy liabilities is the maximum of the TV, the termination value, as well as present value of future cash flows plus claim reserves already incurred. What this means is that effectively, your adjusted policy liabilities is going to be more than your net policy liabilities. There are various stresses that you apply on your adjusted policy liabilities. Firstly, you will apply mortality or morbidity random stress. So these are stresses to allow for the fact that although you hold a best estimate assumption, there could be occurrences where there's just random statistical fluctuation around the mean. And then you've got your mortality, morbidity future stress. So this is, for example, if you misestimated your mean. So let's say when you set an assumption, you did not take into account that in future, more and more people are going to claim for mental health. So that is something that you have to take into account as a future stress. You've got your event stress, for example, pandemic. So these are things like SARS, Ebola, etc. Longevity stress. So this is the stress where if more people survive, more people leave, it's actually, it results in a worsened experience for your company. So for example, for annuities, where the obligation for the company is to pay an amount to the policyholder for as long as they survive, if more people leave and they live for longer, you actually have to end up paying more. Lapse stress. Lapse stress is to allow for the fact that if policyholders lapse, there'll be different experience for your company. We have to apply stress both upwards and downwards. So think about it, if you have a generally profitable policy, you would want the policy to stay on. But there could be instances where if the policy lapses, it actually results in a better experience for your company. So for example, for a level premium policy, let's say, and let's say that person took it out at age 20 and he was going to pay premium for 30 years. So the premium that he pays is the same from age 20 to age 50. But the probability of this person dying, let's say, will be different from age 20 to age 50. Obviously, he has a higher chance of dying at an older age. So if we were to value this policy at age 40 maybe, it could be that the premiums that he has paid in the past has actually been really high, but then the premiums that he paid for age 40 to 50 is not enough to cover the probability of him dying, i.e. the true risk cost at that age. So for the company, at age 40, if the policy lapses, it's actually better off. And finally, we have expense stress. So if you've got more stresses on expenses, if your company incurs more expenses, it's going to worsen your experience. Important to note is that there is diversification allowed for between random and future stress, event stress, and longevity stress. This is to allow for the fact that there's some negative correlations going on with those different stresses. For example, if you have higher mortality, it means that you probably have slightly lesser longevity. The other thing to note is that management actions can be allowed for, but it cannot occur within 12 months of reporting date, and it cannot be used as a response to random stress and event stress. So for example, in future stress, if you think that experience is going to deteriorate over time, your company is probably going to reprice. You're not going to sit there and take the losses for all the years to come. So that's where management actions come in. So after all the stresses are applied, the insurance risk charge is calculated as the stress policy liabilities, i.e. your adjusted policy liabilities with all the stresses applied on it, minus the adjusted policy liabilities, and is tax affected. I'm going to go on to the other risk charges. So we've also got asset risk charge, which essentially allows for asset liability mismatch. All the stresses are prescribed in the standards, but they essentially allow for interest rate stress, inflation, currency, equity, property, credit spreads, and default stresses. The key thing to note here is that what this risk charge is trying to capture is what happens to your assets and liabilities when an asset stress happens. So for example, in the case of interest rates, when an interest rate stress happens, your fixed income assets, that value would change. So that's on your asset side. But your liability sides, which are valued using a yield curve, that would change as well. So the net impact, i.e. assets minus liabilities, that be reflected in the asset risk charge. And again, this is tax affected. We've also got aggregation benefit, which allows for diversification between your insurance risk and your asset risk. And again, this is a prescribed formula. You've got an asset concentration risk charge. This calculates the amount by which your individual assets exceed certain limits. And these are all prescribed limits varying by type of assets. One of the examples would be reinsurance. Let's say you reinsure a whole lot of your policies with one reinsurer, and if that reinsurer fails, the impact on your company, especially in terms of capital, will be great. So this risk charge tries to contain that risk, tries to allow for that risk by saying that any assets above that limit is considered an asset concentration risk charge, i.e. you can't get capital relief as if you have any benefit above that limit. We've got operational risk. This is basically a proxy to allow for any operational risk in your company. And it is a prescribed formula which grows in line with premiums and adjusted policy liabilities. Operational risks are things like if a whole team gets taken out, if everyone gets chicken pox or something like that. And it has to be noted that there's a penalty in the standards. There's an additional charge that applies if your business grows or shrinks more than 20%. So this is trying to, as I said, this is a proxy trying to reflect a real world situation. If your business grows or shrinks really quickly, it's likely that you will have a lot of operational risk involved. Finally, the combined stress scenario adjustments. What this does is that the insurance stresses, as well as the asset stresses, are applied together, and the PCA is increased by any tax benefits that you get when you calculated your insurance risk charge and your asset risk charge, which cannot be realized. And also any management actions that you take when you calculate IRC or ARC. There's only so much management actions that you can do. So for example, if you decide to reprice to overcome some stresses, you can't reprice your policy and say, tell the policyholder your premiums are increased by 400%, for example. That's not going to sit well. So this combined stress scenario adjustment is to allow for any unrealized tax benefits as well as management actions. So that's it. That's all I have for today. If you want to find out more about capital, there's a whole bunch of standards which I've listed there. They're pretty interesting to read, actually. No, I'm actually serious. So now you've heard all about capital from me and policy liabilities from Tyson. It's time to pass on to Kirsten, who's going to talk about value.
Now, you can tell that I'm a little bit taller than Kwang Yi, so I might raise that up. I also talk really loudly, so I'll try and stay away from the mic. So I'm going to talk about value reporting, and in particular, what value is, why we calculate value, who cares about value, and how we actually perform the calculation. Now, to give you a bit of an overview, I work in life insurance reporting for TAL. I probably spend a quarter of my time calculating policy liabilities and capital and doing the analysis on that. And I spend a quarter to maybe half of my time on value reporting and things around value. So it's pretty important at TAL and a lot of companies. So it's a really interesting topic. So we're going to start by talking about what is value. Value is what something is worth. This something can be anything. It can be a car, it can be a company, it could be a person. And how much it's worth depends on who you're talking about it to and when you're talking about it. Take my car, for example, the red thing over there. I bought it 5 years ago for $25,000. That's what it was worth to me then. I'd sell it today for $12,500. That's what it's worth to me now. But you might value it differently. You might not place any value on the black metallic paint, the rear spoiler and the alloy wheels that I paid extra for and pay less for the car. Or you might really like my number plate, which isn't special to me at all, and therefore pay less for the car. This example illustrates some of the different definitions of value. For example, the historical value is the $25,000 that I paid for the car 5 years ago. If it would cost me $20,000 to buy the same car today, that would be its replacement value. If I could sell it for $12,500, that would be its market value. These definitions of value apply to assets of all types, but there are also some definitions specific to companies. For example, net assets. Net assets are the value of a company's assets less the value of its liabilities. You might know this as equity for shareholder companies. There are also some life insurance specific definitions, embedded value and appraisal value. That's going to be the focus of today's presentation. Embedded value refers to the net assets of the life company plus the present value of future profits expected to be made from the in-force business. Appraisal value is a similar concept and is calculated as the embedded value plus the present value of future profits expected to be made from future new business, that is, from policies the life company hasn't even written yet. Ultimately, the definition used will depend on the purpose. Accounting standards might require to use historical value. Market value could be used if you were buying or selling. Replacement value might be used by my boss if he was trying to work out whether or not to fire me. And embedded value or appraisal value might be used where there's no active market for an asset and therefore no reliable market value. It should be noted that a lot of these definitions of value are related, and I'll talk about that a bit more later when I talk about how to calculate value. So now that we've defined value, let's talk about who it matters to and why. If you were to ask me why we calculate policy liabilities and capital, I'd tell you because we have to. There's a legal requirement to calculate both. But there's no legal requirement to calculate embedded value. So why do it? And my answer to that is because people care about value. Now, who are these people and why do they care? On this slide, I've listed a few of the different stakeholders in life insurance companies. We've got the current owners of the business, and that could be a company or it could be an individual shareholder like you or me. I own shares in Westpac, for example. You've got future owners of the business. You've got management, and then you've got other. And for me, other here includes policyholders, regulators, and actuaries. But there might be many other stakeholders that you can think of. Now, the current owners of the business are going to be interested in how much the life company is worth and how the value has changed over time. This could be for personal interest. For example, I might own shares in AMP and would therefore be interested in knowing what AMP is worth and how that's changed over time. That could help me make decisions about whether to buy more shares or whether to sell my existing shares. Now, I could always look at the share price, but the share price isn't always the best indicator of value. They might also be interested so they can calculate their own value. Where the owner of the life company is another company, that company might use embedded value when reporting it as an asset on the balance sheet. My company, TAL, is an example of this. We're a wholly owned subsidiary of Dai-ichi Life, and Dai-ichi Life report us on their balance sheet at our embedded value. The owners might also use this information to make decisions about management. For example, if value is continually declining, they might make the decision to get rid of management. All of them, they're gone. If value is increasing, you might give management very big bonuses. The future owners of the business are going to be interested in how much they should pay for the business. While price and value aren't the same thing, value can be used as an indication of price. And then we get to management. For me, management are probably the biggest stakeholders, and they're interested for a number of reasons. Firstly, they want to know how the business is doing, and value is a measure of that. You can look at value at the company level to see how the business is doing overall. You can look at value at a lower level, like a product level, to see whether different parts of the business are more profitable and to see whether there are any cross-subsidies. For example, your retail business might have positive value that's offsetting negative value on your group business. If the mix of business were to change and you all of a sudden sold lots of group stuff, you might have negative value overall. You can perform an analysis of change to see what's causing the change in value. Is it predominantly due to interest rates, which has been a big thing lately? Or did you get a big capital injection during the year? Are these masking experience losses? All of this provides important information to management and helps focus their attention. If the value of your retail book is reducing, this might indicate you need a reprice. If the value of your group book is increasing, you might want to try and grow this part of the business. A second reason they might be interested in value is to support business decisions. Showing that a particular management action, say a reprice or a change in reinsurance arrangements, will increase your value can provide support for making that decision. You can also use value to choose between competing alternatives by working out what the increase or decrease in value is from each option. Another reason value is useful to management is that it shows the longer-term impact of assumption changes and current experience. As Tyson mentioned, changes in non-economic assumptions like mortality, expenses, lapses have no impact on profit in the period the change is made. So say your claims experience this year is 10% worse than you expected, and you think that's going to continue, so you increase your claim assumption by 10%. The only impact on profit this year is the 10% higher claims for this year, but value reduces to reflect the entire 10% increase in claims. So your value decreases to reflect that you expect to make less profit in the future. Finally, management are interested because the owners of the business use this to assess their performance. Management often have a KPI around increase in value. For example, they might be set a target to increase value by 10% over the year. If they exceed the target, they might get a bonus, and if they don't, they probably won't. So, in addition to current owners, future owners and management, we have our other stakeholders. For me, I said that those were policyholders, regulators, and actuaries. Now, policyholders and regulators probably aren't going to be that interested in the calculation of value. Policyholders want to make sure their claims get paid, and they can get that surety from the policy liability and capital calculation. Regulators have interests aligned with policyholders, and therefore may also not be that interested in value. And this is partly evidenced by the fact that there are no reporting requirements around value at the moment. That could change though. Actuaries care though. We're the ones who have to calculate the value. Appointed actuaries have to provide advice and report on the financial condition of the company, and value can be a really big part of that. And actuaries can also be a part of management, and therefore interested from a management perspective. For example, the CEO of TAL is an actuary. So, now that we've agreed that we have to calculate value, value is very important, how do we go about doing it? We have prudential and accounting standards that give us principles for calculating and disclosing policy liabilities and capital. These standards are backed up by guidance notes and many years of established practice, so it's reasonably clear what to do to calculate policy liability and capital. Sometimes this changes though. When we get new reporting standards for policy liabilities, the calculation is going to be a bit unclear again, but for now we could say it's reasonably clear. We don't have any of this for value though. There aren't any prudential or accounting standards and not many sources of guidance. This has resulted in inconsistencies in the calculation of embedded value between countries and even between companies within the same country. But as value reporting has increased, some common practice has emerged. So let's talk about this. It's generally accepted that embedded value is calculated as the net worth of the life company plus the value of its in-force business, which I'm going to refer to as VIF. We then have variations in the calculation of these two components. The two variations that I'm going to talk about only differ in whether you include capital in the net worth or in the VIF. The next slide shows what this might look like if you include capital in the VIF. In this example, your net worth is then calculated as your assets in excess of capital requirements, and your VIF is the present value of future profits plus releases of capital. So let's see if I can get the laser pointed away. So on the left here, we have a simplified life insurance balance sheet. We have your policy liability, which, as Tyson said, is made up of your best estimate liability plus your profit margins. We've then got capital we hold in excess of the policy liabilities, which will be the prudential capital that Kuan Yin talked about and potentially target surplus. And then we have assets in excess of capital, which is your net worth. On the right, we've got your embedded value. This is made up of the full value of your net worth. And then we have the present value of capital releases plus the present value of future profit margins. The best estimate liability is excluded, as this is required to cover future claims and therefore has no value to shareholders. This is a good place to come back to the definition of value and how the definitions are related. I mentioned earlier that you could calculate value as the net assets. In this diagram, that would be the net worth plus the capital. But this ignores two important things. Firstly, it ignores the value of profits expected to emerge from the liabilities. Reported liabilities are made up of your best estimate and your profit margins, but only the best estimate is required to pay future claims, with the profit margins belonging to the owners of the company. Secondly, it includes capital at face value, when in reality we should deduct a cost of capital to reflect that capital isn't immediately distributable to the shareholders. Allowing for both of these gets us to embedded value. But this ignores the present value of future profits expected to be made from future new business. Adding that in gets you to appraisal value. And this appraisal value can then be thought of as an estimate of the market value of a life company. It's only an estimate though, and the actual price may differ for a number of reasons. For example, there might be lots of potential buyers which would push the price up, or there might be heaps of life companies for sale, for example, all 28 in Australia, and that'll push the price down. Other factors include the skill of negotiators, the willingness of the buyer-seller, and whether the buyer is willing to pay a premium for control. I'm personally a terrible negotiator, so I always pay more for something than it's worth. So now we come back to the calculation of embedded value. The calculation we just went through includes capital in the VIF. The advantage of doing this is it recognises that capital isn't immediately distributable to the shareholders. But one of the disadvantages is that you place a higher VIF on parts of the business that require more capital. This can send the wrong signals to management. For example, VIF might increase and management might think, great, this is fantastic, let's write more of this stuff. But VIF might have actually increased because the business became more capital intensive, and that's not a good thing. So the alternative is to include capital in the net worth and deduct a cost of capital from the VIF. Now, the calculation of net worth is relatively straightforward and can usually be done using the information on the balance sheet, and therefore it may not actually require the input of the actuaries. But VIF, on the other hand, VIF is the present value of the future profits plus the present value of future releases of capital, where you include capital in the VIF. And this requires a projection of profits and capital. And this is definitely a calculation for the actuaries. Now, when Tyson talked about the policy liabilities, he talked about how this is made up of the best estimate and the present value of future profit margins. So you might think to yourself, great, that's one part of the calculation of VIF sorted. All I need now is capital. But there are some important differences between the calculation of present value of profits for value and for policy liabilities. Firstly, methods. For policy liabilities, you could use a projection or an accumulation method. Under an accumulation method, your profit margins are implicit rather than explicit, and you need a projection method to get the explicit profit margins you need for value. Secondly, you could have different assumptions. The biggest assumption difference is probably going to be your discount rate. For policy liabilities, you use a risk-free discount rate. But for embedded value, you might use a higher discount rate to reflect the uncertainty of your future cash flows. Therefore, the present value of future profits for value tends to be lower than for policy liabilities. And you'll often find that the choice of discount rate is the most material assumption in a value calculation. You might also use different expense assumptions. For policy liability, you have to set your expense assumptions to cover your expected expenses for the next year. You can't allow for any future improvements in expenses, for example, because you've got a big project going on to improve your claims management. But you can allow for these in value. So all else being equal, you might find that the present value of profits is higher under value than under policy liabilities. You might also allow for future changes in pricing, increases or decreases that you don't do in policy liabilities. Your other assumptions are likely to be the same, i.e. best estimate, but they can vary. The last thing I wanted to talk about was capital. Companies are required to calculate the amount of capital they need now, and they might be required to calculate what they think they're going to need in the next couple of years. But where you include capital in the VIF, you need your future capital releases in all years. So this requires a projection of the capital you need in all years. So that's a very basic overview of the calculation of embedded value. And there are lots of complications that I haven't talked about. Tax. Tax is one of them. Tax complicates everything. Things get complicated as soon as you start talking about imputation credits, deferred tax assets, deferred tax liabilities. So I'm not going to say anything further about that. Participating business is another complication. Embedded value only considers the value to the shareholders of the company. And so the net worth is shareholder net worth, and the present value of profits is the present value of shareholder profits. If you have participating business, then you also have policyholder assets and policyholder profits. And you need to make sure you exclude these in your value calculation. Non-owner assets also complicate the calculation of net worth. Again, your net worth can only be shareholder assets, so if you have subordinated debt, you need to exclude that. And lastly, we have target capital. So I said you could include your capital in your VIF or in your net worth. But capital is actually made up of your prudential capital requirement that Kuan Yi talked about and target capital. You can include your target capital in, you could include both your target capital and your prudential capital in VIF. You could include both in your net worth, but you might actually include target capital in one and prudential capital in the other. So some extra considerations there. And there are lots of other complications too, but I won't talk about those. To wrap up, I just wanted to talk about where you could find more about value. A great source is financial statements. Many companies disclose their value and the methodology for calculating this in their financial statements or other shareholder reports. I know when I was studying, I had a look at the financial statements of AMP and Zurich to get a better understanding of how value is calculated in practice. Another source is the Actuary Institute Prudential Guidance 199 on economic valuations. Now, this isn't specific to embedded value or even to life insurance companies, but it sets out some generally accepted practices and techniques for calculating and disclosing economic valuations. And the last source I wanted to talk about was the European Insurance CFO Forum Market Consistent Embedded Value Principles, MCEV for short. That's a bit of a mouthful. These set out the principles for calculating and disclosing MCEV for European life companies, and most European life companies follow these principles. And if you actually visit their website, so the link's there in the pack, you'll find lots of information about embedded value. So that's it for me, and I'm going to hand back to Niall to make some concluding remarks, and then we'll get into questions.
Okay, thanks very much to the three guys here, Tyson, Kuan Yi, and Kirsten. They've all done, I'm sure you'll agree, a very good job of covering these topics, which are very important topics for life actuaries in particular, but in all areas of life actuarial work. I think these topics touch us. Currently, I head up the valuation area in RGA, and these three topics are some of the core things that our team do. They're very important for us. We spend probably 2/3 of our year is spent on either calculating policy liabilities, looking at capital, or looking at value. So it's certainly very important from a valuation perspective. I've actually spent most of my career working in pricing area, and equally, although not immediately obvious, I think these are also extremely important there too. Understanding how profit will emerge on a new portfolio you're considering, knowing the capital requirements and how capital intensive that particular business is, and having a view of value and shareholder value, again, is very important from a pricing perspective too. Again, thanks to the guys for such informative discussions. I'm just going to, before we move on to questions and answers, I'm just going to cover a couple of potential further reporting topics, just interested from the crowd in terms of for future events, some of these topics, if they're of interest to the group. I won't go through all of them, but I think some of the interesting topics I think would be interesting to know about would be things like analysis of profit. I think I'd like to hear more about that. That's kind of see some of the next step from some of the things the guys have talked about here today. Risk margin setting, a very challenging process, which I think every insurer is regularly going through in Australia in particular since the introduction of LAGIC, and it's certainly various methodologies depending on which risk you're trying to set margins for. And again, I think that would be a very interesting topic. And some of the other ideas around market consistent embedded value and bringing some of those other value options to the fore would be good as well. So I don't know if people want to have a think about what topics might be of interest and maybe come back to us and let us know, and we can build that into future events. So with that, I'm just going to hand over to questions. If anyone's got any questions from the group, I know we've got some questions here also. So as I said at the start, there is no silly question in all of this. The point of this session today is for people to learn. So feel free to ask any questions that may not be clear to you, or anything you might be interested in. We've got a strong panel of experts here today. So if you want good answers, I think now is a great opportunity. So with that, has anybody got any particular questions from any of today's speakers?
Maybe we start with these ones.
We'll start with those ones. It's probably a good idea.
So I had a few. First two are related. I'll stay. And the question was, can the profit carrier be PV premiums instead of PV claims? And how do you decide which one to be used as the profit carrier? I'm going to try and quote the standard here, but it's something along the lines of the profit needs to be recognised on the latter of the provision of the service or receipt of income for that service, which suggests that it should be claims. But the general principle is that if the profit signature is not materially different from that which you would get using claims, then you can use it. The next question, which is related, is what do you mean by capitalise immediately the loss when the product becomes loss-making? So that's a good question. I talked about how within the liability there is an allowance for profit, which was the present value of profit margins, but the profit actually gets released each year. So say you've got a present value of profit of 100 and the discount rate was 0, and you were going to earn 10 of that over the next 10 years. If you capitalise that value, it would be 100. Otherwise, under MOS, you would earn 10 per year. So what I mean by capitalise immediately when the product becomes loss-making is that you change your assumptions and you're expecting to make $100 worth of losses. Instead of earning that over 10 periods of minus 10, it'll be minus 100 immediately. So, I mean, that's a regulatory requirement, but there's obviously various reasons behind it. And I think the main idea is that effectively, if you're making losses, that's a decision from the current group of shareholders. And so that loss should be capitalised immediately and not shared with future shareholders. So it's for equity reasons. The third one is a little bit more complicated. And it is, you spoke about new international accounting standards, changing the way liabilities need to be calculated. Has there been any indication on which products this will affect? And would we know directionally what the impact will be? So just to take a step back on that one, the new international accounting standard is IFRS 4. There was a draft released in 2013, and there was a lot of debate since then. So since then, there's been quite a lot of industry consultation with the International Accounting Standards Board, and a lot has changed since then. despite that it's meant to come out next year, there's still quite a few things that haven't been finalised. For instance, I think the treatment of participating products is due to be finalised about now, but it should be fairly similar to the current approach. I'll mention a few key changes that are going to happen when IFRS comes in. The first one is this idea of a contract boundary, and under the new standards, the acquisition costs that we're currently deferring can only be deferred over the contract boundary. And the contract boundary is defined as something along the lines of when you can reprice for the risk. So I think the interpretation from the Australian industry is that for our sort of standard vanilla YRT products, which is what I was talking about, you can reprice each year. So that's actually going to have quite a material impact on policy liabilities for YRT products in Australia, where effectively that DAC that we talked about will only be able to be amortised over a year. So the cash flow stream that we're going to end up looking like will be more like the nominal cash flow than the planned profit. That's probably the most significant change, and we expect that the industry will adapt to that through various means. It could be things like reducing initial acquisition expense so that that initial strain is less. And so there's other things like the Trowbridge recently, which will also contribute to lowering initial commissions. And the other change that I will mention that could be quite significant is the unit of account, which is the level of aggregation, which is not something that I'll go into too much detail on. But I did talk quite a lot about grouping of policies. So under the current standards, we have this rule of this idea of a related product group, which is products with sufficiently similar characteristics, and you can group those up, and losses and profits can offset within that group. The unit of account under IFRS will be significantly lower, so it'll be a lower level. Originally, they were talking about policy by policy, so if you sell a policy that is, if your pricing has a particular policy that is very profitable and a particular policy that is loss-making, you'll no longer be able to group them together. Again, that's something that hasn't been finalised yet, but it could have a significant impact on Australian balance sheets. So I guess directionally, what impact is uncertain at the moment. Certainly, the contract boundary will increase initial liabilities.
Before we move on, Tyson, is there any experts in the audience who want to add on any comments about IFRS 4? So we've got some experienced actuaries around who might have some comments to add.
That was all that I had.
I've got a couple. Got a couple here as well. Got two questions from Capital from the webinar. The first one is, how will you allow for legislation changes or any emerging risk in the capital calculation? So I think this is more of a judgmental kind of capital calculation, which would probably be included in target capital. As for how it should be calculated, I think my guess is as good as any. Any experienced actuaries in the audience who want to talk more about this? So emerging risk and risk of legislation changes.
Yeah, or maybe I'll just cover that. You're right. I mean, we've got a prescribed approach for calculating our PCA, and so that's going to be, you've got to make sure you're meeting your standards and allowing for that. You have got opportunities around risk margins to deal with particular risks that you're worried of within the PCA calculation itself. Target capital is another mechanism where you can also where companies will also allow for I guess further uncertainty that's not included within the PCA calculation. That's I guess more a management-owned process.
Well, another one here on economic capital. So it says more and more companies in Europe and America moving to economic capital from formula-based capital. Do you think that Australia and New Zealand will likely do the same thing, move to economic capital? So I think this is we have to separate two things here. We have your prudential capital, which is what is prescribed. So that depends on industry consultations and as well as what the regulator thinks that the direction that we should be moving to. But if you've got your internal capital, I think that's a company decision, especially if you are, let's say, owned by an overseas company and they are moving to economic capital. It is likely that they will want you to use internal capital calculations that is based on economic capital. And I think also in our standards, it is said that we can use it's not just a standard-based method. So those slides that I covered today was based on the standard method. You could use your internal method, but it has to be consistent with the principles set out by EPRA. So that's what I have to say about this moving to economic capital thing. Any other comments from the audience on economic capital?
Does anyone know if anyone is actually using an internal-based method to calculate their capital versus the prescribed method?
I don't believe anybody is in the
Maybe
life,
on the banking
not in the
side,
life
or-
side,
yeah.
but I think on the GI side there are one or two. Yeah.
That's all I have from the webinar. Any other questions from the audience?
Brett Picker from Suncorp. Do you see any areas in the capital formula where it might change in the future?
Sorry, yes, can you repeat your question?
Yep.
I can do it. Do you see any areas in the capital calculation that might change in future?
I think there's a few things in there which might change in the future, but I'm not a regulator, so I can't tell you for sure. So, for example, operational risk, which I mentioned, we are using premiums and adjusted policy liabilities as a proxy right now, but again, that's a proxy, and that could change in the future. And there are other emerging risks which might occur as we go along, and the regulator might tweak the capital calculations as those risks emerge. So you used to have CAPAT and solvency capital calculations, and we see that has changed with our current logic standards. So I wouldn't say that that's not possible.
From the valuation side, I've been practicing in health for the last 6 years, so I'm one of the dummies that this is for. Yeah. When you change your assumptions, it gets buried in a reduction of the value of future profits, and yet from the investors there will be fewer future profits in the future. So is that an event that must be disclosed to the stock exchange the moment it happens, that change of assumption, even though it's buried even though it's not visible in the liabilities?
So companies need to disclose what their assumptions are in their financial statements. Often they're quite wide ranges. So in that sense, it could be varied, but this is where value becomes very important. And from a shareholder perspective, you would see that come through in the value of the company. And that's why it's important for companies to report both. And I think we're moving in that direction, and especially when the new accounting standard does come out, and selling new business can have a negative impact on the P&L position, but it might have a positive impact on the value. Anything to add there?
No, I mean, the typical financial statements, you'll disclose your change in assumption. They won't flow straight to.
Doesn't really so much about the future profits.
No, that's right. So yeah, I guess you won't see it directly in financial statements.
There will be more and more value reporting as part of the financial statements or in supplementary reporting. You often see the analysis of change, which will include changes in assumptions, and so you'll see the capitalised impact of changing assumptions in your value reporting.
Yeah, that's right. Yeah, but yeah, you won't see it in your typical.
It's not a daily stock market declaration. We've changed our assumptions and future profits.
No, definitely not. No. A lot of companies are giving market updates on embedded value changes as they happen, and I guess that will be the mechanism for that to happen.
You do report the components of the liability though, so you will see what the present value of the property is. So if you have a significant amount of assumption changes, they will see that report.
Okay, that's
Can I check that question back to you, Tyson? If you used an accumulation method and you don't necessarily have those components explicitly split out, do you still see them? Sorry, that's kind of a curly question.
No,
Maybe
you,
I'll try that again.
you won't see that in the
You won't.
accumulated method.
Okay, so you
Yeah.
can kind of hide your group losses then if you do accumulation. Interesting.
Yeah, I
Pretty
mean,
hard to hide though, to be honest.
You mean, yeah.
yeah. If you're on the accumulation method, you won't see that separated out. So you'll certainly the embedded value type measures will be your key way of seeing that in that case. Again, the financial statements will disclose which method is used. You'll be able to see the breakdown off the back of that if it's there. Any other questions from the group before we move on to Kirsten?
Right,
You've
we're
no
not
questions?
really back on yet.
Oh, we don't have any
I don't
questions.
have any questions.
No questions.
Okay. Okay. Last chance for the group for questions. So we've got a panel of experts here, so we do have. It is a great opportunity to learn from their expertise. Yeah. Okay, we've got another question.
This has to be for you too.
Well, you deal with that in mind. This is just a thought that was provoked by what Quan Yu said, or at least the question of Quan Yu was there anything that should be changing or would be changing in Magic? I can remember the days when the LIWFPC actually used to occasionally organise feedback sessions to tell them how the current standards were going, and they would use the experts of point actuaries around town and gather ideas for what might change and how they talk about and see whether anything should change. I might suggest that it's not happening now. We've been in process now for more than 2 years using Magic. There are certainly some areas where one could suggest it might be improved. For instance, there's common talk about large flips, which refers to discontinuities in the capital requirements that occur when what should be relatively straightforward continuous changes happen occasionally against set values. So if there are, it might be time now to start thinking about values to be related to that directly. And I'm sure Afro will be delighted to hear answers to feedback on the yeah.
That's a very good suggestion. Okay.
My question for Kirsten about the value.
Okay.
It's not a hard one.
Really hard. I'll look back
So I was interested about your comments about the difference between value calculator and the price that would actually be paid in a transaction. Would you say that in principle they should be the same, but they only differ due to practical effects, such as the ones you mentioned?
Yeah, you could kind of think of embedded value or appraisal value sometimes talked about being the fair value. So the price that an asset can be exchanged between two parties and, well, I can't remember the full definition. But yeah, you can think of it as a fair value. So it is kind of the true worth, but then actual things happen that change it. So lots of buyers or lots of sellers and people freak out. If you needed to sell something really quickly, you might be willing to take less for it and yeah.
And sorry, just to add on to that one, I might calculate a certain appraisal value being a seller. You being a buyer might calculate a completely different appraisal value because you've got different assumptions and you've got a different cost of capital. So obviously that's another interruption.
I meant more from one viewpoint. So viewpoint being the principal inputs, so assumptions and things like that.
Yeah, so the
Holding
buyer
those
and seller.
concepts. Yeah.
Cost of capital can vary dramatically. So you've got all the underlying assumptions the same. The discount rate can change depending on what their funding costs are.
So those would be a synergy.
Yeah, I think one example that I would say was, for example, if you were to buy an insurance company, so let's say I was working a few M&As before in Indonesia, so it depends on what the purchaser thinks of the future potential of the company is. So let's say you think that the company has potential to make X amount of new business, you would be ready to pay more. Or for example, if you think that you want to get a foot in the market, you'll pay more. So like what Kristen and Tyson say, it's all about the viewpoint you're coming from.
Yeah, just to add to that point, I mean, if you've got two, for example, you've got an insurer who's predominantly in individual risk, and you've got another insurer who's predominantly in group risk. The diversification benefits that you get from merging those two companies together could mean that there's different views of value in terms of standalone versus as a combined entity, and that can also play into views of appraisal value.
Any other questions? I might repeat that question for people on the webinar, which was in old capital standards we had a new business reserve, and do we allow for that under new capital standards or in some other way?
So you're right. It depends on how you want to look at it. So under Logic, we evaluate basically based on in-force business at the point in time. But like I said, if you were to write one more policy, you would technically be in breach of PCA, which is why you have target capital. So that would probably be where it comes in. And a company would usually hold, for example, in Intel, we don't just hold target capital, we hold X amount of target capital. So that's where the allowance for capital for new business comes in.
Okay. Assuming that's it, there's no other questions out there. I think we'll wrap it up. I'd just like to again thank the group here for doing a great job today. I think it's been very informative, and I hope you've all learned something new today. So thanks a lot.